Good afternoon. We've come out of the day with the Standard & Poor's hitting an all-time high and the Dow Jones Industrial Average being down. So the market is choppy, and it's been choppy for about a week or so, and it seems like it's probably going to be choppy for a while because it's digesting how bad this pandemic is, how effective the vaccinations are, and all of that is really making the difference. It's a vaccination market, it's a COVID market, and it's very positive. Big economic growth, big earnings. So we stay on the train, we're looking for that. But there are two questions that are plaguing Wall Street from a bigger perspective, more longer term perspective, and I want to touch on these today. The first one is inflation. And almost every pundit, every economist on Wall Street is signaling higher inflation, and the bond market is signaling as well, with bond prices down and interest rates up. But our perspective at Cadinha & Company is a little bit different. And I want to talk to our chief economist, our interest rate and our inflation brain, Dr. Victor Canto. Victor, what's your take on inflation?
Well, Harlan, I believe that inflation is a monetary phenomenon. Too much money chasing too few goods. So the question is, you have to get a measure of whether there is too much money or too little money. And essentially, we do that by looking at the monetary aggregate. Most people do. And they say, M2, the money supply is growing at double-digit rates. And that's inflationary. And everything else is same. That's true. And as I'll show you in this chart, you can see the money supply has grown fairly quickly, and it's growing at the red line here. The money supply is growing at around 25% per year annualized rate. And that is what has a lot of people worried about inflation. But that's only half the story. We say the other half is the demand for money. And let's look at the velocity of money, how quickly money is being turned around. And you can see the velocity of money has collapsed. And as the velocity of money collapsed, that means people are holding more money and it's absorbing all that money supply that's being printed. If you look at the graph, the declining velocity exactly matches the increase in the money supply, and the two of them cancel each other out, leaving the monetary system in balance with no inflation whatsoever. We're watching the velocity of money as our key indicator to see whether it's going to be excess money supply or not. Back to you, Harlan.
Yeah, no, that is really good perspective. It's unique perspective, but this inflation question plagues all kinds of asset classes because it affects interest rates, which is a discounting mechanism for all asset classes. There's another worry abounding about Wall Street, and that's the Biden tax plan. In a nutshell, the Biden tax plan is not good. There is not a piece of good in there in terms of economic effects that we can find. Whether you get a piece of it, a section of it, or the entire thing, it's bad. But the question is, how quickly will it be bad, and how quickly will the market react should this tax plan be passed? And the passage itself is questionable because the majority vote is very, very thin. One or two minds changing their view on this thing within the Democratic caucus, and all bets are off. But we've been studying it. Victor, what can you tell us about the tax plan that you can see?
Well, we know that businesses have a tough time. Adjustment is costly. Things don't happen overnight. But one thing we do know is that this administration wants to increase the corporate tax rate, and we know they want to raise the personal income tax rate. The question is, how do you take advantage of that, and what will be the impact? One simple way to reduce or minimize the impact of the corporate tax rate component is by corporation to issue debt, because then the interest paid on the debt gets written off against the corporate tax. So we believe that the corporate debt is going to increase. The other issue is, how do you minimize the impact on the personal income tax rate? Well, the argument here is that instead of paying dividends, what you want to do is retain the earnings and reinvest them by acquiring other companies or whatever. So, and that will reduce the impact on the personal income tax rate, because like an IRA, you compound interest rate tax-free, and you only pay the tax at the end. So we think that the Biden tax increases will lead to what? To increase corporate debt and increase emphasis on acquisition and capital gain generation as opposed to dividend generation.
There you have it. You know, we have been scratching all kinds of numbers, trying to come up with a plan. And until we see something definitive by way of passage, we don't put any of it in place. But it's generated a lot of hours of thinking, and it does present a convoluted future. Anyway, that's it for now. We'll keep you posted. Thank you very much.
Thank you.